Good morning, traders. Steve Ganz here with another episode in the Compare and Contrast series. So today I'm going to compare and contrast what are probably my two favorite trades. The bulk of the trading I do is comprised by one of these two specific trades. And I tend to like them because they tend to have very wide P&L zones. You can see this is in SPX, which is my personal main trading vehicle. And we can see that, the break-evens here are very, very wide. This is a 100-point wide trade, 100 points in the SPX or the S&P 500. So that's a fairly wide range that I can, play in and look for this position to decay. In this particular case, I'm evaluating these two positions out on July 21st. So obviously that's a ways away. That's about a month and a half, 46 days out. So these two trades are both 46 days out. They are both butterflies, although I'm comparing, again, the put broken wing butterfly to what I call a flat butterfly. In other words, it's not a broken wing butterfly. So what does that mean? Let's come back to our flat fly. So the flat fly basically means that our two short strikes are at the same location. In this particular case, I did them at 42.90, which is where the market is kind of around right now. So this is what we call an at-the-money fly or a centered fly. So the two short strikes are at 42.90. And again, in this particular case, I've done equal wings, 50-point wings on this butterfly. So why 50-point wings? Well, there's no real specific magic to 50-point wings, but something that I always encourage my students to do, particularly if you're learning to trade a butterfly or some sort of a trade that you're planning on repeating over and over, like we do on a monthly basis here. And select a width that you are comfortable with. Again, whether this is a butterfly, whether it's a vertical, whatever it happens to be, and trade that same configuration as closely as possible for a period of time. So like in my case, I'm often trading a 45, 46 day out, often 50-point wings, and I kind of learn over time what that trade costs. So in some cases, so right now, this trade is going to cost me $690. Now, I just know mentally that's a little higher than I normally pay for this trade. You learn that over time, and you also learn what impacts that price. In the case of butterflies, it happens to be volatility. So when volatility is higher, butterflies become cheaper, which is a great thing. Again, one of the other reasons that I really, really like butterflies. But that's not what we're here to talk about today. What we're here to talk about today is just comparing these two. So the regular put butterfly is 50-point wings on both sides, which means that I have an equal amount of risk on both sides. In this case, it's $680 on either side of this, of my tent. We're going to call this our tent here. Now, if we look at the broken wing butterfly, you can see that this side is 60 points lower, and this side is at 50 points. This is what's known as a 60-50 butterfly. So when or why might I use one over the other? We should also note, just looking at these two, this one, it's only going to cost me $440 to get into it. However, the max loss is higher. The max loss is here to the downside on this particular trade. So I can't just count on the fact that my max loss is going to be what I pay for this particular trade, which is the $420. So here we can see that on a flat fly, our max loss is equal to the amount that we pay for it. But again, not true here because our wings are not equal in width. So why would I use one trade over the other? Well, let's take a look at like a market condition here. Here is the current SPX, And this is daily bars on this chart. So what might my expectations be if I'm looking at this as a trader? Now, of course, everybody does their own technical analysis, and you need to kind of have a general sense as to what you might expect from the market. I will tell you, in my reading of this chart, we have broken out of a wedge pattern. That's a very bullish sign, usually. And many times these breakouts can take off and run. But what I do like to look at is, well, we're coming into resistance here at this 4,300 mark. We've hit 4,300 before, rolled off it. Also, I tend to look at, well, what have our recent runs been? Well, here we went from 4104 up to 4207. So let's just call that 100 points. Here we went from 4,100 to about 4,200. So let's call that 100 points. Here we went from 4,150 up to 4,290. So we're a little over 100 points. So basically, when I look at this, my general mindset or my sense is that we may be looking at a time of a little bit of a rollover. Does that mean we're going to have a big sell-off? Not necessarily. But am I thinking that, well, the last three waves here have been a little over 100 points. We're a little over 100 points now. Maybe that wave is over for a period of time. Yeah, I am kind of thinking that. That's kind of my thought process right now if I were to look at a technical analysis. So in that scenario, which one of these am I more likely to potentially consider? Am I more likely, if I'm expecting the possibility of a little bit of a pullback here, okay, am I looking at more of a flat fly or a broken wing fly? Well, the way to really know that, in my opinion, is let's compare. I'm going to drag down here all of the stats, if you will, on these two. So let me line these up here, enlarge this a little bit if I need to. This will allow us to kind of compare the two, well, not side by side, but one on top of the other. So this is the regular butterfly. And the stat I specifically want to look at here in this case is delta. So the flat fly has negative delta. Now, negative delta means that this trade is going to be slightly favorable in a little bit of a pullback. It's going to create value in the trade a little bit faster as the market falls. Where this one is essentially what I will call delta neutral or flat delta. So if I'm expecting maybe a little bit of a market drift down or a little bit of a market pullback, I would probably lean a little more towards something that might have some negative delta associated with it. So let me show you what that looks like on the P&L diagram. So if we come into these two P&L diagrams, I'm going to come to the broken wing butterfly, or excuse me, to the flat fly first. And this is, of course, at expiration, what the value of this position would be. And if you guys have watched any of my video series before, you fully understand that I am never trying to personally, pin this and attempt to get $4,000 out of this trade. That would mean that it would have to expire exactly at 42.90, exactly on July 21st. That's a lot of unlikely ifs to happen. So what I do in my trading is I look to take a little piece out of the middle. So if we come back and we put this trade on today, we're going to essentially be at a break-even point there. But as time rolls forward, let's just roll forward to, let's say, July 5th. So after 31 days in this trade, you can see this dark green line is what's called our T0. That shows you what the value of this position would be. And again, all these are guesstimates or estimates based on options modeling software algorithms. And there's no guarantee that this is going to happen. There's lots of other things that come into play here, such as, is volatility higher, is volatility lower? those are some of the things that come into play. But the software is modeling that this position might have about a $220 profit in it as we get out to, again, around July 5th. But notice the slope of this line. The slope of this line, we actually get slightly more profitable as we go down in value, or as the S&P drops in value. This is what that negative delta factor means. So if I were to put this trade on here and I were to get some time decay and get a little bit of pullback, this trade could have some nice profit creeping into it. This is out on, again, July 5th. So let's take a look and see what happens with our butterfly in the same, our broken wing fly in that same scenario. So again, we go and we put on this trade here today. So we're in the same boat where we're essentially at no P&L. And then we march this forward to July 5th. So we have here about $190 in profit. So it's a little less profit in this trade. But the thing that I want you to take away here is specifically look at how relatively flat or rounded, just a mild grade either side that this line has to it. So this is delta neutral, essentially. So what that means is it's not going to be hugely impacted by a down move in the market or an up move in the market. Okay, that's one of the things that you need to do and consider when you're putting on any sort of a trade, specifically a butterfly, is to set your general market expectations. And the nice thing about butterflies, from my perspective, and the reason that I really like trading them, is I don't have to be real accurate. I don't have to be real precise. I have a very, very wide zone that I'm playing with here. Not only a zone in the tent, but you can see that my zone also goes way outside the tent as well. Now, I'm not sure what just happened here, why I'm guessing that there was probably just some spike in the market or something like that that increased volatility. And that will quickly come back. Let's see what my other one did here. So, no, it didn't really impact this one. But anyhow, you can see that a pullback in the market causes a little more profitability to creep into this one. And an up move in the market will get us into trouble a little bit faster. On July 5th, if we're up here at around 43.50, we're kind of at a break even there. If we come in on this trade, we don't get into trouble unless we get all the way up here to that 43.80 range or so is where we finally start going negative on July 5th. So again, just a much what I'll call flatter curve to the broken wing fly. And this is a little bit counterintuitive because many people would think that the flat fly would have the flatter curve associated with it. And it just simply doesn't. The flat fly has more negative delta with it. It is a slightly negative delta or slightly bearish position, where the broken wing butterfly tends to be a more neutral position. Again, much of the reason for this is that the puts are more expensive than calls are in many cases, because more people are simply trading puts. Your average investor that isn't maybe necessarily an options trader will in fact buy puts on their portfolio at times that they get a little bit scared, nervous, concerned, etc. Where there's lots of reasons to buy puts. You can buy them for trading, you can buy them for protection or insurance. Most people aren't doing that with calls, so calls don't generally have as much activity on them, and their price doesn't tend to get driven up as much. So as a result of that, that's kind of why you end up with this little bit of skew in a flat fly. So what I might suggest on both of these is to literally go ahead and paper trade these, put these positions on, and I'm going to save this trade. And let's see, it's already marked as a long put butterfly, and we're just going to save that. And I will copy that link and put it in the notes below. for everyone. And then I will also do the same here on the broken wing fly. And we'll save that trade. And it already labels it. And we will put this in the notes below as well. And then I would urge people to just watch how these two transpire over time. And again, my personal goal or objective usually in trading these is to look to get 10, 15% out of them while this T0 line is very, very wide like this. In other words, on this trade, I don't have a huge amount of risk at this point. Until you get late in the trade and that T0 line really starts to mound up. Now, here, if I happen to be at this point, granted, I've got a lot more potential profit in the trade, but I can lose it a lot faster. If the market were to drop from 4,300 down to 4,250, I can give back, let's see, that's 2,900. I can give back $2,000 in the blink of an eye here, okay? Same thing if the market runs up as you get that late in the trade. So what I choose to do is come in and right here where a big down move, 42.90 down to 42.50, well, yeah, that does impact my trade. It drops from 200 profit down to 130 profit. That's not gonna bother me too much. So in my personal trading, I tend to put these on and take them off rather quickly as the market is just gyrating in this general range. I don't try to take these close to expiration. So, I may only be in this 45-day trade. I may only be in it for 3 weeks, 4 weeks, something along those lines. Again, that's a personal preference of mine because I went through the whole day trading thing for a number of years. I day traded full time, sitting at my computer, staring at the screen. Just made a conscious decision that is not the way I personally want to trade. So I do trades like this where I don't really have to pay much attention to them. If the market goes up or down 50 or 100 points a day, I know that it's really not going to have a huge impact on these trades. So hopefully that brings some more light to the butterfly series of trades. And again, the put broken wing and just the regular old, what I call the flat fly or the long put butterfly. And again, the big takeaway is the flat fly you would think might have the flatter T0 line, but it does not. It is more of a bearish style trade. And to get back to our market conditions, so if I have a theory or a premise that we might be at a little bit of a market peak here, and we might be a little more due for a pullback, maybe back down to around 4,200, somewhere in that general range. Which of these two might I be more likely to consider? Well, I'm going to be more likely to consider a flat fly in that case because I would be expecting, again, maybe a pullback down here into the 42.50 range or so. And this trade will perform slightly better in that scenario. And it has a little bit lower overall risk associated with it. So it's about matching up your trade to current market environments. And again, that's kind of what we're looking for here is let's look at our market environment, let's look at our expectations out of the market, and then let's try to put on a trade that has a nice wide, I'll call it margin of error associated with it so that I don't have to be right. I just can't be horribly, horribly wrong, and I can still make some money in this trade. So again, we've got those two paper trades on. Watch them progress. It is going to be slow. It's going to be like watching paint dry. But this, over the years, has been a very, very consistent trade for most traders. And there are ways you can adjust this and modify this, etc. That goes pretty deep. I am going to look at a series here very soon called From Start to Finish, where we will take one of these trades and we will put it on, and then we will make adjustments as this trade marches forward if we need to. Many times you don't need to adjust these, but so look for that in the future. Again, I think I'm going to call it Start to Finish, and it's going to be taking a trade from the opening stage, managing adjustments in it if needed, all the way through to the closing stage. Hey everyone, I'm back for a quick supplement here. So I realized that I forgot to mention kind of one of the key aspects of these is how flexible they are. So of course, I mean, a flat fly is a flat fly. There's not much that's going to change about it. I mean, you can change the width of your wings, for example. Let's just say I want a much tighter fly. I mean, I can create a much tighter fly here. In this case, let's see, that would be 20 points either side. So you can do things like that with this trade, but more, I don't usually change my flat flies. I personally tend to leave them at the 50-50 range for reasons I've explained previously. But on the broken wing flies, I can certainly do some things with these to give them a different complexion. Let's specifically look at delta. So again, this broken wing fly is set up to be slightly positive delta, but maybe I want this thing to, be a lot more skewed one direction or the other. I mean, I can come in and I can change this in a lot of different ways so that I have, this is going to be a much more bullish focused trade. Now, it takes on more downside risk, but it's 5.5 positive delta at that point, which means that in this case I have no risk to the upside. If the market were to rip up, no matter how high the market rips, I'm going to at least make $340 or so on this trade. So again, one of the nice things about these is that I can come in and kind of model them or play with them or skew them in whatever direction I want to meet whatever premise I want. Of course, I can also come out and change their days to expiration and bring them out to a much further, a much larger distance in time or a much tighter time frame. So always play with these things and just kind of see how that impacts your trade. But again, the benefit of a butterfly is the extreme flexibility that you have to design this trade to be as bullish or as bearish as you want, and designed to cover whatever market zone you might want to cover. So I just wanted to make sure that I got that little bit of additional information in there. Well, I wanted to compare a flat fly to a broken wing fly. It's important to understand that broken wing fly can be set up a lot of different ways as well. So thank you very much. Take care.